or not, we're beginning the fourth quarter of 2015, and that's always a good time to start thinking about year-end tax planning, especially in light of the current market correction. In this morning's U.S. Bank Economic 360, U.S. Bank Vice President Mike Denman joins Business Watch producer Kelly Leon in the studio to discuss what this means for you and your portfolio. Mike and Kelly.
Thanks, Peg. Hi, Mike.
Good morning.
It's also a sign of fall that you have your pumpkin tie. Like that?
It's October.
So I get the not so fun topics, falling market and taxes.
Right.
How are they related?
Yeah, two really upbeat subjects.
Yeah,
right?
thank you.
Let's take the tax side of that equation first. The taxes we're talking about are called capital gains taxes. And very simply, this is a tax on any investment profits that you might make. So if you sell a stock and it's worth more today than when you bought it, the government's going to want a piece of that profit. So for most folks, it's a 15% federal rate plus some state taxes. But as you mentioned, this falling market might be able to help some people with their tax bills.
Okay, a down market doesn't really sound like it's a good thing.
Right.
Right.
So this is kind of making lemonade out of lemons.
Okay.
But I just mentioned you have to pay a profit or a tax on any profits. The tax rules allow you to subtract any losses from that profit before you pay your taxes. So we haven't had a downturn in the market for a few years, but now that we have, it's worth looking at your portfolio. If there's any investments you have that are lower in value than when you bought them, you could take that loss and help to offset your tax. Nobody likes losses. We'd rather have gains, but if you've got some losses, you can sometimes put them to good use.
So how does it work?
Well, important distinction here. Taxes are only due when you sell an investment. So if you continue to own it, it's just a paper gain.
Okay.
Nothing needs to be done. But once you sell that, that's when the gain and or the loss would kick in. So reevaluate your portfolio. Look to see if you have any investments that are trading at losses. And if so, then you could sell those and use that, again, to help offset your tax bill. You shouldn't sell a stock simply because it has a loss.
Okay.
But it's a good opportunity to reevaluate. Maybe it's not a stock you're enthusiastic about anymore. Maybe it doesn't fit in your long-range plans. Whatever the case, you can sell that stock, take the loss, and then make good use of it. Now, big disclaimer, this is a very high-level overview. Anytime we're talking about taxes, there's always fine print and important details.
Right.
Before you do any of this, probably a good idea to speak with your accountant or your financial advisor.
Yes, I was going to say, it is a great reminder to take a look at these things, but I know for me personally, I'm always calling my accountant to help me out with this. Yeah.
Yep.
And you're always a big help too. Thank you, Mike.
You're welcome.
Thanks for being here this morning.